Good evening, everyone. Welcome to Unifi Portfolio Review meeting this evening. I'll request everyone to kindly write questions if you have anything in mind and post the presentation by Maran sir. We will answer these at the end. Thank you so much. Over to you, Maran sir.
Thank you, Amit. Thanks everyone. Thanks for taking time out to join. About a couple of weeks back, when I was talking first with Mr. Abhishek, one of the discussion point is market valuations, portfolio performance. But there were too many different uh, queries, and I was trying to answer to the best of my ability. Some had quick answers, some had long answers. Then we thought, why not we have a session exclusively for his clients, along with Tushar Bhai's clients, because many times our perception of a portfolio or a market gets driven by the recent performance. It's not unusual. It happens all the time. And we have seen that cycle after cycle, year after year, so many years. And when our performance has been average or below average, sometimes our perceptions get clouded um, with all the negativity around us. When our performance becomes strong, above average, somehow a lot of positivity comes in. It's therefore important to bring our focus into what matters to us. Many times, what we read in newspapers, what we hear from our well wishers in the industry, many times they are not helpful for us to decide whether we should continue to hold what we have, should we enhance our allocation, or should we even consider cutting the positions down. As a fund house, it's not that we do these events, webinars every month or every quarter. We try to do this at least twice in a year. Once, usually around this time, June, July time. Once, usually end of the year, because unlike large caps, where every quarter when the companies announce results and you have 100 analysts tracking these companies, and the price reacts to these announcements fairly efficiently. When it comes to many small mid caps, the price movement happens only when their annual results come. And not many of these companies have active analyst coverage. So when they announce results quarterly, people like us track, but not all analysts track, and the price sometimes may not reflect their recent progress. And to give some credit to many of these companies, their quarterly numbers are bare minimum what is statutorily required, but their annual numbers are reasonably exhaustive. And therefore, it is important for us to review our portfolio performance in relation to performance of the companies we hold. Even though it is a very simple thing, that when you look at equities, whether you buy them directly as a direct equity stock, or through PMS, or through mutual fund, these are all just vehicles. But when you buy a stock, you are buying ownership interest in a business. And as a shareholder, you are not going to get anything more or anything less than what the business that you hold earns. So therefore, it is all the more important for us to look at our portfolio performance in relation to um, uh, what the companies that we invest have been doing. So what I will do is I'll spend a minute or two, maybe a few minutes, in running through some of these performance numbers. But the idea of doing this webinar is not to present these numbers and spend a long time discussing macros or global events or Indian economy. Um, Not that we have any special insight or privileged access to information or some skill set to evaluate what's happening around us better than anyone else. We don't. We are humble enough to accept that. So it is important, therefore, to spend this webinar time in addressing specific queries that you may have. Um, Usually, we avoid discussions on stock specific, which is what we have a full-fledged team whose objective is to do portfolio review one-to-one, where they will do justice by spending enough time in running you through the portfolios that we have, individual stocks we have, what contributed, what disappointed. And therefore, it would be better to focus the portfolio composition details in one-to-one reviews that we do. If some of you have not availed that service, please connect with us and please connect with Abhishek and Tushar. We can get that organized. That portfolio performance review session is one singular thing that we have been investing significant part of our own bandwidth, energy, as well as team to do this. And one primary reason in 2018 and 19, when the Sensex and Nifty was up and our portfolios were down, we still were able to retain a large section of our clients. One singular credit we would give is for that portfolio performance review meetings that we have been doing. So we'll cover individual stock aspects in these meetings, but today's meeting we'll try to cover two very important um, aspects. One is the portfolio performance that has come so far. Where has it come from? Has it come because markets have in general have done well? That's a majority perception people carry today, and we will see in the next few slides how much of that has come from market performance. And if it has come from market performance, how much of it um, um, is sustainable, and therefore it is important for us to focus our attention to what we usually refer to in portfolio performance evaluation. Even though we started working with many of you since 2015-16, we first started with DVD, deep values at discounts, as well as spin-off, where we invest in companies which were doing demergers. Subsequently, we launched APJ20 as a new fund, where we invested in sectors which Dr. Kalam covered in his book called Beyond 2020, where he talked about agri, um, specialty chemicals, mining, infrastructure, and high precision manufacturing. These are all not sectors which were fancied in 2016, and most of the participants in market were bullish on IT, banking, financial services. So this portfolio had a wonderful run since 16 till date. Now we are reaching almost 5 years period. In 2017, we did green fund. First 6 months, 9 months, because of small cap, mid cap, it went up a lot more than what it should have. But 18, 19 was painful periods in green, partly because we were holding small mid caps, and small mid caps in general were falling in 18 and 19. But unlike other strategies in green, the universe of ideas are not too many. And that limited universe, there are 3, 4 investments that we made which didn't work out the way we expected. And we took some time to recognize those errors, correct them, sell, replace with other ideas. And with the benefit of hindsight, now we can say we are glad we did that in 2018, because the ideas that we replaced have done exceptionally well thereafter. Then we did BCAD as a strategy in 2018 after government introduced GST. Even though a significant part of market was focusing on the impact of GST in unorganized sector, like GST, there were few other disruptions that were happening. Demography was one of the biggest disruptor in India, even though it is a very subtle thing and it takes longer time to feel, but it has a dramatic impact in many businesses. So we named this as BCAD, business consolidation after disruption, because during disruption, the small marginal guys get disrupted and businesses tend to consolidate after disruption. When we did that fund, we didn't have a clue COVID kind of good thing could happen, and COVID could be even bigger disruptor than any of the other disruptors that we were focusing. And and one common thing that you are beginning to notice, especially in the last quarter results, is many of the leaders in fragmented businesses, their earnings growth is sharply higher. It's mostly counterintuitive. Many people are expecting weak performance numbers, but many of these companies' last quarter performance numbers is one of the best in the last few years. Because when businesses get disrupted, during disruption, large guys, mid guys, small guys, most of them get impacted. But the impact is very severe for MSMEs, small players, and less so for larger players. So when things come back, it is larger players who gain market share. So many often you will find people confusing large becoming larger along with larger caps, because many of the businesses we invested in this strategy, the largest players are small mid caps. Insider Shadow Fund is the last one that we did last year, March 2020, when we had a sharp 30% fall in markets. Almost all of us knew FIS were the biggest sellers. What we didn't realize at that time, but with the benefit of hindsight, we got to know a little later, were the promoters. The biggest buyers in market are the promoters. And the number of companies promoters increased stake in 2020 is probably 12-year high. And promoters by nature are contrarians. You are now seeing this month maybe 10, 12 IPOs. IPOs are nothing but dilutions in market. Promoters therefore dilute when the going is valuations are attractive, when the company, the sector they belong to is financed by the market. So in normal times, any time in the last 6 years, you would not have seen a metal-based company oversubscribed by 100 times. Only in a market like today, after a 100, 200, 300% rally in metals, you will find IPOs coming in that space, and those IPOs getting 100 times oversubscription, which is a reflection of where the market interest lies. So Insider Shadow is a great fund to have in a period like last year. Even today, majority of the names that you will find in that kind of portfolio are not businesses which are fancied by the market. On the other hand, you will find quite a few names in that business, in that portfolio, into companies which are coming in paper, fertilizer, even broking companies, which are not certainly in the market favorite, because half of the brokerage companies trading in market today are trading at share prices which are less than half of what they were 3 years back, less than half. Okay. Blend as a portfolio has been around since 2017, by far the largest fund of Unifi. Today, out of whatever AUM we manage, close to about little under half of our AUM is in this strategy. The reason why I put this slide is whether you take APJ, some of the leftover DVD accounts, as well as blend. The characteristics are somewhat similar. And if you look at the right hand side Excel table, the year that got over last year, majority of the companies, the earnings have grown around 20% per annum. Last year was not a year when people would have expected any earnings growth in the beginning of the year. People thought it's a washout year and most of the companies' earnings will decline 10, 20, maybe 40, 50%, which it was the case in hotel, entertainment, theater, those kind of businesses. But fortunately, we didn't have any of them. In the previous 2 years, we were investing mostly in specialty chemicals, APIs, pharmaceuticals, some of the gold finance companies, which turned out to be a great decision. Their performance numbers were good and stock price performance was even better. But one thing you will notice is, in spite of the sharp changes in the portfolio, and in spite of the fact that the company's prices have moved up for us, for our portfolio to almost double, not just double from the recent low, even if you take from since inception 2017, the CAGRs have been around 20, 22, 23%. But what you should notice is our current PE multiple is not expensive, because where the stocks had moved 3x, 4x, 5x, we have exited. And what did we do with that sale proceeds? Is not to go and buy other stocks which also have moved up in the bull market, which as a mistake many fund managers do and investors also commit. So we are exiting the ones which are market favorites and PEs are expensive, when we are investing them into companies where the PE is still reasonably priced. So that's one discussion thought I will leave with you. This is strategy where some of the investors may observe it's not growing as fast as any of the other themes that we manage. The most important alphabet in BCAD is the A. So why do we call business consolidation after disruption? Is during disruptions, the impact happens. It may be disproportionate for small marginal guys, but that impact also happens for the larger players. But it is after disruption that you will find small, medium guys getting out or getting acquired, and the larger players gain market share. And that phase is something which we have seen that happening post GST, and hopefully post COVID as a disruptor, you will find a lot more businesses getting consolidated. And in that phase, you will find the earnings growth gaining sharp momentum. And that's what is fair to expect. Already we are beginning to see in road transport, cargo transportation business. We are beginning to see in innerwear business. You will start seeing in many more businesses to come. Inside a Shadow, even though it's got recently relaunched, first time we did this one was 2008. Second time we did this was 2012. Both occasions our experience have been reasonably favorable. Even though last time we did, our first year return was minus 21, and we took another 9 months just to recover that minus 21. Effectively, our 2-year returns were zero. But still, in the fifth year, for another 9 months to leave for the fifth year, we still did about almost 2.8 times, and we closed this fund. Hopefully, this time also our experience will be good, because the PE multiples that we pay for the businesses are reasonably low. The earnings of these companies have begun to grow after a long time, but market either is skeptical of their earnings growth or are not too sure about this. That's why the prices are still lower. And APJ, as a fund, we launched it in 2015 end. So 16 is the year most of our clients came in. So and it's a 5-year 3x target, and majority of these APJ accounts 5-year maturity is coming this year. Few accounts have already matured. Few will get their 5-year maturity maybe this month, next month, because 2016 is when we raised most of the capital in APJ. And here our journey for this period is not as rosy as it looks like. The CAGR number since inception may still be 24%, but it was not 24% per annum. It was something like 50% in the first year and minus 25% second year. And for many investors who came around 2016 and 17 beginning, They had seen net negative for a long time. And in spite of the fact that these companies' earnings were growing 18-19%, in 2018, many of you might have observed how mutual funds were selling small mid caps only to comply with SEBI regulations. But they were effectively selling what we were holding, and therefore prices were falling, even though companies were growing their earnings, which it was so delightful that many of you stayed invested um, based on the trust you had with us. We didn't disappoint it because these companies, their earnings performance, when they improved further more in 2019-20, those stocks began to diverge away from index. And this time, last year when March market fell, of course these stocks fell, but they bounced back very sharply, not the way the market bounced back. Because June, July, August, when these companies were announcing 20, 25, 27% earnings growth, market took notice of it, and many of the stocks we held had done 2x, 3x, 4x. This is one fund where we, most of the accounts that came in 2017 would not have seen 2017 growth of 30%. So they all would have seen 2018 fall of 20%. And that fall kept compounding in 19 also, unlike Blend, unlike DCAD, unlike APJ, because some of the companies we held in that fund, the earnings started degrowing, which we took the course correction in 2019, sold them, replaced with other stocks, which fortunately have come back. This is a strategy we closed in the last few months, in spite of the fact that it was doing very well. Deep values at discounts is a strategy we did in 2012. First 1 year we were effectively minus 15-20%. But when it did exceptionally well in 14-15, what we realized is some of them which were deep values became reasonably okay value, not deep value anymore. But in 2014-15, deep values existed in some other businesses, which is why we kept raising money in 2015 as well as 2016. But the small mid caps rally in 2017 made us the job of finding deep values a lot more tougher. So we closed subscription. By our initial design, we were supposed to have closed that fund in 2019-20 because we stopped in 2017 and it was a 3-year tenure. But 2019-20 was a challenging period, not only for small mid caps, for whole of the market. So we requested our investors to give us 1-year extension. And this strategy, even though it had no management fee and had a high hurdle rate of 40%, we still thought by asking for the extension, by giving another 12% hurdle, whether we make money or not, at least the investors will make money, because the companies we were holding were deep value when we bought and did not go and continue to remain deep value. So that decision of asking for extension worked out beautifully for clients as well as for us. And this recent rally in many of the stocks in deep value portfolios were not as much as market. There are a couple of stocks which went up 3x, 4x, 5x, and that really pushed the portfolio valuation dramatically. But when you book gains in these names, what do you do with that cash? Finding deep values at discounts today is a challenge. So we choose to close this fund and return the capital back in this allocation. Many of you, maybe 90% of our investors in deep value discounts have been closed. Some couldn't get closed because maybe they're NRI, or because they're just waiting for shifting to our AIF fund, or they had their own tax reasons to wait for next financial year, those kind of things. Such investors, my suggestion is please consider shift to Blend, because that's where we see incrementally going forward a lot more investment opportunities opening up. As we closed DVD in 4 months back, 5 months back, in the last 3-4 months, we have been closing spin-off strategy again. This is a fund that we did in 2014-15, kept raising money in 16 and 17. But post 2018, we stopped fundraising. It's a 3-year allocation. So most of the money that came in 16-17 got matured in 19-20. And here again, we asked for extension. And fortunately, majority of the clients allowed us to extend, even though many of them had just seen only the hurdle rate of return, nothing anything spectacular. And in March, when markets fell, this portfolio fell even more than the market. which was somewhat unexplainable because spin-off as a portfolio strategy, if you look at the past also, there's not much correlation between how these stocks move and markets move. But last March, when markets fell, this portfolio fell a little more, and almost about 40% of the portfolio were small cap IT stocks. Like we had Intellect, which was a spun off from Polaris. We had a Mastech spinning off from Majesco that got spun off from Mastech. We had Birlasoft, KPIT demerger. And we also had few pharma names like Suven Pharma spinning off from Suven Life. And most of them did 3x, 4x, 5x. In fact, Majesco was 200 rupees, 300 rupees in February 20, came even below 200 rupees in March 20, and the company gave 970 rupees dividend before the end of that year. So that kind of 3, 4x sharp rise made spin-off, staying invested in spin-off worthwhile exercise. But when we exit these opportunities, we don't have too many spin-off ideas to invest, so we choose to close the fund. This sheet in a one page captures our journey. So the reason why I put is not to lift the collar and present portfolio performance, saying that look at majority of our funds over the last 5 years have done 21, 20, 18, 24, 27. Fact is, some of these 5 years, and if you see 1 year performance, may look, some funds have done 67, some funds have done 139. The very fact that many of them are dominant by small mid caps, but some have given 139, some has given 85, some has given 67, itself revalidates that it is not market movement, which can be overgeneralized as performance of individual stocks. Different portfolios have moved differently based on the underlying company's performance rather than some mid-cap, small-cap index performance. Many of you who have seen me presenting in the past also would have seen me extensively using this graph. This is something which we appreciate because there is no masala element here. It is nothing but small cap, mid cap, large caps just based to 100 over 20 years back. The impression sometimes people carry that small mid caps give higher return, large caps give lesser return, or large caps give higher return, small mid caps don't. One thing you will find cycle after cycle is in a rising market, mid caps rise more than large, small caps rise even more. In a falling market, mid and small falls a lot more, and eventually in panic times, they all converge. The cycle repeats again and converges again, repeats again, converges again. But if you take your attention and see January 2018, that's the peak. Till January 2018, any strategy that you take from Unifi, whether it is DVD, spin-off, APJ, Green, they all have done exceptionally well till January 18. Our trouble started from January 18 when small mid-caps were falling even though Sensex was up. Because in January 18 is when SEBI came with that restructuring, making mutual funds to define each of their schemes as large, mid, small, and any stock they hold outside that space they had to sell because 80% of their portfolio has to be from the same universe which they are benchmarking to. So that made many mutual funds to sell small mid caps, and that pulled down mid cap index by 15%, small cap index by 23% when Nifty was up 12. So that kind of thing, it happened in 2018, but never in the previous 5, 10, 15, 20 years, or never even after that it happened. So it's a history. Even though it's a history, any past performance you take, which also includes calendar year 2018, will give you a distorted picture. So in 2020, when March markets fell, the only big point that we were communicating to investors is while we don't have any clue how things are going to shape up, the convergence of all the indices since March 2020 was a welcome move because if you look at the past, whenever in panics market indices converge, they bounce back. The timing of bounce back was not clear. Certain things like 2001 convergence took 1.5 years to bounce back. 2008 it took less than a year. 2013 it happened within 6-7 months when election started happening in 14. But this time we were not sure how long will it take to bounce back. But when the bounce back happened, it will be very sharp in small mid caps, which is what we were expecting, and that turned out to be very delightfully true. But the last 2-3 months, you see almost like a vertical jump. That's making people to feel nervous. That you don't find in large, you find in small and mid, which is why people are beginning to say, are we getting into some kind of froth in small mid caps? And should one needs to be careful? And if you are contrary investors like us, on one side we are busy booking profits and returning capital, other side we are also raising money and investing in small mid caps. Is it some kind of a counterintuitive stuff that we are doing? Can be answered by the next 2 3 slides. This requires some attention. Even though we try to make it as simpler as possible, this is the simplest we could do. Here, what you find is today we are in June 2021. If you take May 2021 and the previous 3 years, effectively in the last 36 months, the line graph gives you a sense of how large cap index has moved, and each dot that you find is each large cap stock's actual performance in the same 3 year period. It's There are 100 large caps, so you will find 100 dots, and each dot is 3 year return of a large cap stock. So I just put these dots wider in the chart for optical clarity. That doesn't mean this is a large cap performance of May 18 or May 20. Each dot is each large cap's last 3 year performance. But the reason we put the date wise here is to give you a sense of how the index performed in different time intervals. Effectively, in the last 3 years, 100 rupees invested in large cap index, whether it is Sensex, Nifty, or any large cap index, had become about 70 rupees in March 2020, and that 70 is now has become about 140. Okay, so net large cap index in the last 36 months, in the last 3 years, have grown 40%. Okay, it might have doubled from the recent low, but how much it has grown in the last 3 years is 40%. During the same period that the large cap index moved 40%, did all large caps move 40%? The answer is no. There are 10, 20 large cap which have moved 100, 200%, and there are 10, 20 large cap which have given negative return. But majority of the large caps that have moved around 30, 40, 50%. So the returns, individual stocks, actual performance diverge from the index over a 3 year, 5 year period. The reason you can explain these large caps having done 200% and these large caps have done minus 50% during the same 3 year period when large cap index moved 40%. The only way you can explain is by the earnings growth of that companies, and that divergence doesn't happen daily, weekly, monthly basis, but it indeed happens over a 3 5 year period, which effectively is the reason why people like us focus on earnings and not necessarily market index prediction game. This is for mid caps. Here, quickly, optically, you can validate that the divergence is a lot more in mid caps than what we have seen in large caps. So if you look at the mid cap index, had you invested 100 rupees in May 2020, that would have become almost about 65 rupees by March 2020. And that 65 has now become almost about 120. Okay, to be seen with the left hand side. So how much mid cap index has gone up in the last 36 months? About 20%. That doesn't mean it has moved 20% in a vertical 45-degree angle. 100 became 60 and 60 has become 120. So from the recent lows, mid caps have doubled as at the index level. But over a 3 year period, mid cap index has gone 20%. But during the same period, there are 1/3 of the mid caps, about 50 mid cap stocks have more than doubled. And there are 50 mid cap stocks which are given negative return. Stock divergence is very wide in mid caps. So 3 years back, if someone had told you that mid cap index can deliver only 7% per annum over next 3 years, and Unifi's funds are mostly small cap mid caps, should you have closed, you would have denied yourself a 100-150% rally. Similarly, today you may have a view on small cap mid cap index over the next 3 years. The index may go up 20-30%. What is important is whether the 20 stocks that we hold in our PMS are these 20 stocks or these 20 stocks. Because our eventual outcome 3 years, 5 years later, when we hold a portfolio of 20 stocks, is not going to be similar to the index. It will be 100-200% if we are holding these type of companies, and it could be minus 30% if we hold these kind of companies for the same index level we are going to see in the next 3 years. And if that is the case in mid caps, it's even worse in small caps. In the last 3 years, actually, do you find more of red dots or green dots? Fact is, in the last 3 years, the small cap index 100 had become almost about 55 by March 20. That 55 recently would have become 125. So from the recent low, small cap index would have gone up more than 125%. But how much small cap index has gone up in the last 3 years? Not even 10% per annum. Effectively, totally about 25%. In this 25% rally in the last 3 years in small cap, not per annum, totally for 3 years. During the same period, small cap index moved 25%. Majority of the small caps are still today lower than what they were 3 years back. Some of them have gone up more than 100, 200%. So what matters in small mid caps is companies we hold, not the index. That's the broader point I'm trying to communicate. That's my brief presentation. We'll be happy to take questions. Yes, sir.
Thank you so much, sir, for your insights. I will take few questions which I have received from investors, and post that I'll request Abhishek, Tushar, and Subhash to contribute their questions, whatever they may have. In the meantime, I request participants to write their questions in Q&A box. So the most popular and fundamental question people are asking is, our portfolios have done really well over last 1.5 years. So their question is that should they be holding the portfolio, or they should partially start profit booking? That is one part of the question. Second part is, or they should actually add some money.
If the portfolio has gone up, what is portfolio growing? Prices of the companies we hold have gone up. Share prices have two variables, earnings and PE multiple. If a share price has grown because company's earnings grew, if you are owner of that business and business earnings have grown, then share price growth is logical. In the last 2 years, previous 2 years, the company's earnings went up, share price did not, because PE multiple shrunk. So price P is equal to E, earnings multiplied by PE. In 2018, when our portfolio prices declined 20%, earnings of these companies did not decline. Earnings was growing 15-20%, but PE multiple fell 30%. 1 year over. 2019, the portfolio did not decline, did not go, but earnings of the company was still growing 20%. Price did not move because PE multiple fell further. There was a 30 to 40% PE decline in 2018-19, which when it came, all came in 6 months, 9 months. It's like we were drinking water from a fire hose. It just gushed in. But when it gushes in, we should be conscious of how much of the PE decline has come back. Minus 40, 100 that became 60, 60 has become 100, which means 60 becoming 100 has come from the PE multiple adjustment. And during this period, earnings has grown maybe about 18, 19%. So out of the return that we earned last year, maybe 18, 19% is for the performance of the companies that we held last year. Maybe 40, 50% came for the performance of these companies we held in the previous 2 years, but we didn't get reward over, right? But we usually, when companies move from cheap valuation to the other end, when the pendulum swings, it doesn't swing to the equilibrium. It goes to the other end before swinging to the equilibrium. When it goes to the other end, what are we doing? If we had given us 100 rupees and we bought 10 stocks, 10 rupees each, and that 100 has become 300 because some of these 10 stocks moved 300. If I'm holding the same stocks, then this question is very important question to ask. My portfolio has gone up. If I'm holding the same stocks at 10, 15 PE, which now has become 30, 40 PE, then this is a time to book the profits, which is what we have done even before our clients have asked to do. Okay. After booking these profits, so if I'm holding Moat Finance at 8 PE, we first bought it at 10 PE, earnings went up 20%, price did not, so it became 8 PE. But in the last 1 year, how much earnings has grown? 30%. But how much stock has grown? 250%. So PE multiple from 8 became 20. So what did we do? We have sold. Navin Fluorine we bought in 2018. Stock, company's earnings grew, but price did not. Price actually declined a bit. And PE multiple shrunk. But last 1 year, earnings have grown 20-30%, which is fantastic, but price has gone up 150%. So we have exited. So wherever prices moved up a lot, because what was cheap PE became expensive PE, we are not waiting for investors to redeem. We are selling them. Internally, we have redeemed from investments which have become expensive, and we have invested into investments which continue to be cheap. When we run out of ideas where to find ideas which are cheap, which is when you should close the account, but before you close the account, we will be closing the fund. For example, if it is time to redeem, we didn't wait for redemption in DVD or spin-off. We were calling investors to redeem. Okay, but in APJ, what are we telling investors? Stay invested. Why? Here there is lot more steam left, lot more earnings steam left. And inside a shadow, we are raising money. Blend, we are raising money. So, if you are investing in a mutual fund or a PMS or an AAF, where you input money 100 rupees and that got invested in stocks and those stocks have gone up and the fund has the same stocks, then you have to do the profit booking. Whereas here, the fund manager has already done the profit booking, whether you are going to stay invested or redeem. So if you are redeeming today, what we are going to sell to return your money is what we have bought last 1 month, 3 months, which continues to be 18 PE, 19 PE stocks, not 30, 40, 50 PE expensive stocks. Yes, yes, sir.
Thank you, sir. So another question is about our open themes, blend and insider shadow fund. So the question is how much we have raised so far and for how long will we keep it open?
One good thing you will notice in the last 20 years that we have done is, even though our assets under management have gone up to a level where we feel little embarrassed about it, sometimes size is something which can be counterproductive. And indeed, it is counterproductive, especially in small mid caps. So we are conscious of the size. So most likely, Insider Shadow Fund will stop for subscription now. The capital that we have raised is about 440 crores. We want to stop at 500 crores. Blend, because it is blend of multiple strategies, the only strategy where size we have flexibility is blend, because in Insider Shadow it is 500 crores. BCAD we stopped at 730 crores. Holdco, when we did 3 years back, we stopped at 200 crores. Different strategies have different limitations. In blend, first time we did 650 crores in 2017-18. Second time we did in 2019, we did about 500 crores. This time maximum we want to go is 800 crores. So we will, I think, Insider Shadow for sure we will close by June. Blend most likely by July, August.
Thank you, sir. I'll hand it over to Abhishek for his set of questions.
Yeah, sir. Sir, a lot of clients are asking this question that we have been here in 2017. And that time you didn't tell us to sell because you told the same story that the earning growth of these companies is good. But still we saw a huge fall in 18 and 19 and we had a very bad experience. So why don't we avert this coming fall, if it comes, that we don't know, and book the profit now, because we are sitting at 34, 32, 27% CAGR. My 2019 investment is nearly touching double digit. So isn't it prudent to take out money from the small cap, mid cap space? Because even if the P's are down or 17, 18, 20, and the earnings are still coming, when market falls, it just falls across. It does not see everything, these kind of things. So what would you say to that, sir?
If an investor have a strong opinion that we are going to see 2018 kind of thing, because he has some kind of a premium thought, such investors should exit. We don't think so. We can't take portfolio action today because we had something similar happen in 2017-18. Because 2018 happened, why? There was a regulatory action. Okay. What people don't realize, in 2017, the previous 3 years mid-cap index went up 300%. What is last previous 3 years mid-cap return now? 25%. Is it not an aberration to compare mid-cap today with mid-cap in 17? It is not. It is huge aberration. correct? So different people have different perceptions. Our perception is driven by fundamentals. Our perception is not driven by, who knows, probably something else could happen in the next 3 months, 6 months, and market could fall 20% and we may fall 30%. But that is not the reason why we should continue to invest, because we will continue to invest if the companies we hold business are growing 20% and if the PE is low. If the prices are going to fall because market is falling and PE is going to become even cheaper than that, it's great to continue to hold. If I have liquidity requirement at that point of time, then I may have to force myself to sell low PE. If I'm buying at low PE and it is going to become lower PE, that's not a reason not to buy when it is low PE. So here, such opportunities, what we are disregarding are two things. One, after maybe 7-8 years, we are getting into high profit margins. Okay, our belief is in the next 3 years, the cumulative earnings corporates will make. Say if you take BSE 500 companies, the next 3 years earnings will be much more than the previous 6 years earnings. I won't be surprised if the next 3 years earnings is as much as last 10 years. Because we always connect economic activity with business turnover with profits. That's how our mind usually thinks. If GDP is doing well, economy will be doing well, businesses will be doing well, profitability grow. But between 2001 and 2009, our GDP grew 7% per annum, but net profit growth of Nifty companies was 27% per annum. Okay, 2009 and 2015, economy grew at the same rate, and profits grew 4% per annum. Why? In between, there's a huge capex flow, there's huge liquidity flow, and cement capacity doubled, steel capacity doubled, power generation capacity doubled, capacity utilization declined, cost of capital went up, corporate credit went up, margins pulled down. Last 3-4 years, we didn't see any private capex. The cumulative corporate debt in 2020 was lower than 2015. Loan outstanding has declined. The rate at which banks are lending money, for example, HDFC's home loan rate now is the lowest in the history of the company. Company was started, by the way, in 1977. So we are at a 46-year low. Okay, so your interest rate is low, loan outstanding is low, and last 5 years you didn't invest in huge capex, so your depreciation is low. And on top of it, September 2019, government has cut your tax from 35 to 25%. So what you are clearly observing is 2019 net profit margin was 4.6% of the sales across these companies, and that is a 19-year low. And the same in 2009 was close to about 9.4%. And if you take over any 10-year period over the last 25, 30 years that we have been tracking, it's about 7%. So 4.6 to come to 7% itself will be a 50% rally, right? So in the next 3 years, when the profit margins revert back, and we are based on data, it's not some assumptions we make based on certain future events to happen. So here there is a reasonable visibility that the margin expansion next 3 years is not just driven by some cost cutting. It is the cycle which is turning, and that's not turning for one type of companies, it's turning for a broader market, which is why price is running ahead of the earnings growth. Sometimes intermittently you may see that as high PE, but the earnings growth of the last 10 years, what is the net profit growth of Sensex Nifty companies last 10 years, 2010 to 2020? Across all Sensex Nifty companies, which includes Asian Paints, HDFC's, Bajaj Finance, as well as all the other companies, it's hardly 5% per annum, right? Is that how we are expecting the next 5 years, 10 years to grow? No. We think it will be 18, 20, 25%, which for some people may look like an aberration, because next 3 years earnings to be 20% when the last 10 years average was 5-6%. But there are enough fundamentals to make us to think so. So we have that belief, and that belief is what is making us to continue to hold and probably increase our allocation to those names. So in the next 3 years, 4, 5 years, if we lose money, we are not going to lose money because of some macro events or FIs selling or market fall. It will be maybe because of stupid stock picking in the first place. As long as we don't do that, I think eventually we will come out independent of where the index is. Even though there is a 3 months, 6 months, 1 year risk, like in 2018, what happened in the index could hurt us. But our last 3-year return is not as much as index. In the same 3-year period, when mid-cap index has moved 20-30%, many of our mid-cap funds have done 100%. So I think we should give that credit to the performance of the companies we had, not to the market. If we are willing to tolerate 1 year pain, if markets turn bad, we will turn bad. If we don't want that pain, then probably the best action is to sell and go.
So one more observation. So there is a saying in the stock market that if you are going to a barber shop for having a haircut, and a barber says that which stock we should buy, this stock, or he starts recommending stocks, that is a top, and you should leave the barber shop immediately half shaved and immediately call your broker and sell all the stocks. Now there is, in some cases this is happening, because my liftman yesterday asked me which stock to buy, and because a lot of people have started broking accounts in Zerodha, even ISEC, and even all the broking accounts are seeing the top of demat accounts and number of accounts. So don't you think this is like because junk stocks are rallying, especially penny stocks, 12 rupees, 15 rupees stocks. So are you not seeing that kind of bubble in some pockets of small cap? Because we are investing in small and mid cap area.
What is the average market cap of the companies we have? 12,000 crores. What portion of our portfolio is companies below 2,000 crores? Not even 5%. So 95% of our portfolio is not in junk side of the market. Number one. Almost 30% of the portfolio we have are companies above 35,000 crores market cap. As everyone is going this way, we are going this way. You should be liberal in your risk assessment when valuations are very attractive. You should be very clear in your risk assessment when valuations are rich, right? So as people go more and more small caps, micro caps, our median market cap, which used to be 6,000-7,000 crores, have already become 13,000-15,000 crores. Number one. Number two, many of the junk stocks are not zero debt companies. 14, 15 out of 20 companies. What gave us so much confidence to sail through 2018? Why did we think that none of these companies will go bankrupt? Because they never leveraged. Their return on equity was still high. If you are in a business where on the capital that you invested, you made 20-21% and you are growing at the same rate, you don't need capital to grow. And we were willing to take P&L risk. Earnings could decline, earnings could go, but these companies are not going to go bankrupt. This small junks going up. Junk stocks went up even in 14-15 and market continued to triple thereafter. Junk stocks went up in 2004-5, market continued to go. So in all market cycles, you will always find excesses. Are the excesses widespread? Are the excesses come on top of high valuation? Both we should see. We have excesses, but it's not widespread. If it is widespread excesses, Motilal Oswal should not be trading today half of the price 4 years back. Okay? Lupin should not be trading today at the same price it was trading in 2012. United Spirits should not be trading at the same price it was trading in 2014. Godrej Industries should not be trading at the same price today as it was trading in 2016-17. Excesses are not there. There is a weighing mechanism, right? So when Sensex is 52,000, maybe one section of the market is trading as if Sensex is 80,000, which is where you find 60, 70, 80 PE companies. And some of the companies with no earnings, but still traded abnormal valuations because they are small caps in sexy sectors. There is another one section of the market which is very cheap, but they are a scary place to be in, which is where you put steel companies. And they are all at 1/3 replacement value, 0.3 book, some of them like PSU banks. They're cheap, but they're cheap for some good reasons. Maybe because their last 10 years earning growth would have been 0. Maybe because they have 3:1, 4:1 debt equity ratio. So if you get it right, you will double the money. If you get it wrong, you may lose capital. That risk we don't want to take. In between these two are the pools of ideas where there may be 1-2 exceptional company in otherwise boring sector like broking. It may ICC Securities may be an exceptional company. JK Paper may be an exceptional company within otherwise a boring sector like paper. So it is this space where either the earnings have grown but market has skepticism on future earning growth, or it may be like Lupin or Godrej or in a space where the earnings have not grown for 4-5 years, but we are expecting the earnings to resume growth in future. And if it happens, market will change its perception. If it doesn't happen, then we need to change our perception. So as a contrarian, we are buying. The beauty of this is what will prove whether these companies will eventually do well in the next 3-4 years is next 3-4 year performance of these companies. As long as we are like a hawk's eye, we have oversight on them and monitor them every quarter and make portfolio correction when the earnings don't happen, brutally sell them and replace with other companies where the earnings grow. And if that earnings growth is going to be 18, 20, 21%, we are not hassled by any potential market decline of 20-30%. But if market is likely to go because FIs are going to buy, but the companies we hold are not going to grow, we may as well sell them and return the capital back to the investor. So we need to be clear of what is making us to buy. So what is today making us to buy is our of the few companies that we are buying, the degree of visibility of their future earnings growth. And still the price we need to pay to buy these companies is not super expensive. It's very nominal. With regard to your observation on number of brokerage accounts opening, the media is putting a different picture. We are all, actually people don't realize household savings in equities in India in 2016 was lower than 1991. Okay. If you take household savings in 2016, say, what is savings? Annual savings, about 34% household savings people make. But accumulated savings is invested. That's called household wealth. If you take household wealth in India in 2016, about 82% was real estate. About 6% was gold. 2.5% was equities. Okay. All the financial investments put together was about 7%. Chit funds used to be 2%. South and East had more chit funds than equities. Can you believe it? So this is India 2015-16. Then you had between 2014 and 19 no return in gold. You had demonetization in 16. You had RERA in 17. Right? You had disruption in unorganized business. And household investments were not going into real estate. When you have a household wealth where 82% of that is real estate, which means 80% of your savings was either saved to buy a house or is getting saved to meet your EMI commitment. 80% of whatever you are saving was going into real estate. Now, last 3-4 years, today, 2/3 of India is aged below 34. Right? Half of them are women. Women in 20s, 30s, 40s are not buying as much gold as they used to buy in the previous generation. Okay? And the men, just take the average age of billionaires in India, 2001, 2011, 2021. You will see a steady, sharp decline in the average age of the billionaire. You can see yourself. In fact, we did that exercise. What is the average age of an investor who had 1 crore account with us? It has gone down sharply. So because wealth accumulation is happening. For example, if you take the average age of a home asset owner in India was 46 in 2001, 34 even 6 years back. Today in Pune, it has become 29 average, which means a lot of people are buying houses at 24, 25, 26. There are some people who are buying at 35, 40 also. The average age is below 30. Pune is the first city to break that. And this is an indication of the demography and the wealth accumulation happening at a younger age. We can see that in our own industry now. At your age and my age, the average wealth, what people carry is much more than what it was 10 years back, the India average. Right? And that wealth is not going to real estate and gold the way it went in the previous generation. And large portion of it is happening in equities. For example, mutual funds raised more money in 2015 and 20 than what they raised in the previous 15 years. Is it because of mutual fund performance? Mutual fund performance in 2015-20 was less than the previous 15-year average. Okay, mutual funds did far better job between 2001 and 9 than what they have done in 15 and 20. But 15 and 20, what mutual funds are raised is more than what they raised from 1994 when mutual funds were allowed to be privatized. Since then till 2014 was less than what they raised in 15 and 20. So point is, the fund flow, financial flow that's coming is not brokerage account number of opening. Why then you explain SBI mutual fund has overtaken HDFC mutual fund. SBI life insurance become larger than HDFC life insurance. SBI cards will become larger than HDFC cards because in the segment where this transition is a lot more sharper happening, it's not in Metro because Metro was not this skewed. Metro anyway had financial investments almost. If you take 2015 mutual fund AUM, 38% of the mutual fund AUM was Bombay. Okay, 18% was Delhi. So you mean to say 56% of India's financial asset is Bombay and Delhi? No, but Bombay and Delhi was 58% of mutual fund AUM. So the transition in tier 1, tier 2 cities, non-metro urban places in the last 5 years has been very sharp, lot more sharper than the transition in metro, because metro was anyway little more diversified thanks to financial advisors like you. In 2015 itself, metro was reasonably diversified, but that was not the case in non-metro towns, which now has sharply gone thanks to Jandan, government initiatives and mutual funds, good job, private insurance companies penetration. That's why the flow to bank deposits is the highest. Today, the bank deposit rate is lowest and the flow to deposits is one of the highest, right? Which bank doesn't have any pressure in raising money? So the financialization of savings is a larger long-term concept, and equity accounts is just one portion of it. It's more to do with demography and the wealth creation side, nothing to do with the media is putting a picture that it's because people are locked in and they were sitting at home and they have nothing else to do and they have started trading. That's just maybe a small portion of it. Maybe one liftman asking anecdotal evidence sometimes may not be truly representative of many things. Our belief is we are nowhere near any peak of market valuation.
Last two questions. So one is, if I have new money now and I am already invested in blended and my performance has been really good, so should I consider Insider Shadow or should I add in the same blended fund? And number two question is, if I think I forgot the second question. You can answer this one.
This question.
Yes,
just because we have another theme doesn't mean one should invest. Insider Shadow, risk-wise, little more risk than blend. Because blend is evenly balanced across different ideas coming from different themes. In a scale of 0 to 10, if you put, let's say, a typical diversified equity fund at 5, maybe Bitcoin at 10, our blend could be somewhere around 6, and Insider Shadow could be like 7. BCAD may be like 4. So in Insider Shadow, we are contrarians. So we are buying businesses whose prices are cheap, but their earnings growth is not predictable. And therefore, before that, it could slide. For example, last time we did Insider Shadow, we had first year return of -21. And we took another 9 months just to recover that -21. So, but eventually in the year when we closed, Insider Shadow went up 71% that particular year. So you will find that kind of movement in Insider Shadow. So if you have 100 rupees and you already have another 100 rupees and you are adding 100 rupees, maybe combinedly, if it is 20, 30% in Insider Shadow, it's okay. But not more than that. If you are going to keep all the money in blend, it's fine. But if you are considering Insider Shadow, it should not be more than 20, 30% of your overall portfolio allocation with Unifi.
Yes. So last question is that now stock picking of Unifi has been very good because we were holding mid-cap IT, mid-cap pharma, specialty chemicals much earlier when people started looking at it. So that has played out really well, and we have booked also a lot of places. Now, what do you think in the next 3 years will drive Unifi performance? Because you said fertilizer is one of them. Any other things which you think will do well?
Fertilizer is only a very minor call. It's not a big theme like the ones that you listed out. The ones you listed out, you will find 2 new categories coming in. One is there are broader aspects of consumption which have slowed down a lot. Media is writing about people don't have money to buy 10 rupees biscuits. the household savings have dramatically reduced. Leverage has gone up. So the picture that we are hearing in the MSME sector is dramatically bad. But the consumption pattern of India has been improving. The impact of that improvement was not uniform for all players. The leaders, the large is becoming larger, and small and medium players are suffering. If you take broking industry, a lot of small brokers have suffered in the last 5 years, 10 years. Regulatory changes, margin changes, business become capital intensive, compliance intensive, and brokerage rates have fallen. So small brokers are out. But Zerodha is gaining market share. ICICI Securities last year, first time in the history of the company, made 1,000 crores net profit. So it is indifferent. So you might have seen the last quarter results of all innerwear companies. Take all the innerwear companies. Their last 3 months profit is more than the previous 1 year. So media should not write that innerwear industry cyclical is people are locked down, so they are using. They are not. The unorganized industry, the unbranded, loosely branded guys who are thriving by buying yarn, hosieries in cash, using migrant labor, access to local credit, giving high margins to small shops, and those guys are out and gone. Right? These organized players, whether it is Page Industries or Dollar or Rupa or Lux, these guys were mostly zero debt, which means even though for whatever they sold before March 2020, after lockdown, they could not get their money back from the shops. They had enough cash and access to institutional credit to restart their working capital cycle. They didn't have migrant labor essentially. So their labor was available when they restarted. And they had capital enough to complete production and leave stock with the shops. And the stock was available when normalcy can turn. So you will begin to see, for example, you don't need statistical evidence. India doesn't mine golds. We mostly import. Our import of gold in the last 5 years have declined from $52 billion to $17 billion. And you talk to any jewelry friends, he will tell things were bad in the industry last 3, 4, 5 years. Because the trade itself has shrunk in value. But what is Tanishq earnings growth from their jewelry business? 28% per annum, including last year, in the last 5 years. So that is big trend in the next 3 years. You will find many aspects of businesses where the paper industry may get shaken and 1 or 2 guys will go for bankruptcy. And there will be another guy whose profits are going to move from 300 crores to 800 crores. And he is now trading at 9 PE. That mispricing can be in such businesses where the impact of what we are going to see in the next 3 years is not uniform for all players. Therefore, instead of taking a sectoral call, this is next 3 years journey is going to be in the consumption-oriented businesses where stock selection skill, if you have, you can pick a lot of, which is why we went and bought a Mahindra Holidays or Indian Hotels, in spite of the fact that the industry has been in deep trouble because some of these guys have zero debt balance sheets, strong balance sheets, and they will survive. And they may even get some of the other assets at markdown values. The next big thing is the manufacturing operating leverage, which is going to come back, very sharply in several businesses. And many people, as I mentioned, I began saying, many of our inferences are influenced by last 1 year, 2 year, 3 year thinking. Some of these companies have been around longer, and last 3 years margins may not be reflection of what they are capable of generating in the next 2, 3 years. And there, your earnings growth is still not yet priced in. So it cannot be just restricted to one sector, but there are at least there are 4 or 5 pockets in market within manufacturing space where valuations are reasonable and we have good ideas flow and institutional interest hasn't come in there. I think if they play next 3, 4 years, payoff will be very sharp.
I am done with my questions. Tushar bhai or Subhash can add.
Maran sir, I have one question. The APJ has, it's on the verge of completing 5 years. So do you have option of, extending it by a year or two as we did in spin-off, or people can, reinvest into the same theme for another 5 years? So what are the options and what are the view on the APJ as a theme?
Till had you asked this question, say last year, we would have told. We even told in a webinar that we are going to unwind the next year. But now our view is we will unwind DVD for sure. We'll unwind spin-off for sure. Green we will unwind 2022 July for sure. APJ we are not going to. APJ we are giving choice to the investors to reset. There is anyway no lock-in, no exit low. So reset is as good as whether you are extending 1 year, 2 year. If you think you want the money 2 years later, reset now and take 2 years later. If you want money 3 years later, you can take. The reason why we are giving reset is we are confident. There are 5 broad businesses in APJ we said. If you refer the APJ brochure, the first page will have 5 things: agri, specialty chemicals, manufacturing, mining, and infrastructure. We didn't invest in mining. We invested in 4 other businesses. In one business, we lost money, agriculture. In one business, specialty chemicals, we made so much money that it covered all these losses and portfolio has come to 23%, which we exited. The big portion is manufacturing and infra. These two, when it comes back, it's not going to be uniformly for everyone. The guys with no debt, strong balance sheet, high return on equity, their growth comeback will be very sharp. I think it's an opportunity not to live away with. So our suggestion to APJ investors is reset and take a call instead of resetting, extending 1 year. By giving reset, one benefit is your current capital, current value becomes the capital. Last time when we allowed extension, capital was still original capital and your hurdle rate was only original capital. So in APJ, by resetting, any future hurdle rate will be on the current capital, which gives you a sense of how confident we are that APJ, even from current levels, will deliver reasonably outstanding results. Yes, sir.
Sir, one last question on the portfolio construction towards the blend. We are having higher allocation towards the banking and financial services sector. So are we very bullish on that particular sector, or?
See, BFSI is a broader definition. What was our allocation to BFSI when we first did blend? We didn't have a single private bank.
Yeah.
We started buying private banks only March 2020 onwards. After they fell 50%. It's an opportunistic allocation. It's almost like a cash. At some point in future, we may sell. In the BFSI, we are also putting ICCI securities, which is actually not financial services or banking. It is more a saving side of the BFSI, not the lending side of the business. So it's not that we are bullish on BFSI as a broader thing, but there are 2-3 interesting opportunities which are unique to them, like State Bank, like ICCI securities. That's not a reflection of our optimism towards banking industry. It's more a reflection of those 2-3 businesses that we are investing.
Thank you so much, sir. I'm done.
Tushar,
Hi, sir. Hi, sir. Sir, can you? We have many investments in BCAD. The theme has given good return, but compared to APJ and Blend, it has given less return. So, can you give some light?
in 2018 and 19, when APJ fell 25%, when Blend also fell 15-20%, BCAD did not fall. You remember?
Yes, sir.
Because BCAD was mostly B2C, consumer-driven, brand-oriented companies. And 2018-19, when small cap, mid caps fell, such companies did not fall. Mutual funds were not selling them because those businesses were anyway fancy. The most important alphabet in BCAD is A, after disruption. So during COVID disruption, many of the companies we held in BCAD also have suffered. but they have suffered less than their peer group in unorganized sector in the same business. So there were 2-3 changes that we made. When we started BCAD, we looked at GST as a disruptor. But when COVID became a disruptor, there were few positions that we held in the portfolio which got impacted, which we have exited and replaced with companies which are going to benefit from after disruption of COVID. So when you see those benefits coming, you will find them very sharp. So the risk content of BCAD is much less than blend and APJ, which is why I said in a scale of 1 to 10, if you are putting a diversified equity fund at 5, blend may come at 6 and BCAD could come at 4. The risk content of BCAD is much less because majority of these companies are household names, brand driven, leaders of their respective businesses, and none of these companies are going to get into economic vagaries or defaults. Maybe 15, 16 of them are out of 20 companies are zero debt, high return on equity, 25, 26%. So hopefully in the bounce back, when you see demand in consumption moving, after disruption, these companies come back will be sharp. I don't want to make a comparison with blend and APJ versus BCAD because relatively BCAD is a lot more safer strategy. It fell less in 2018-19, even though small mid caps fell. It didn't go up sharply in 2020 because it didn't fall much in 2018-19. Can it deliver 20-25% CAGR in the life of that fund, which is what it is supposed to designed it to deliver? My answer is yes. So this is not a time to feel unhappy about BCAD or shift to something which is moving fast. We should not.
Okay, sir. Thank you, sir.
Sir, if there is a room for one more question, there is an interesting question from the investor that as recently ESG funds have done really well. So is this a time to have a relook at green fund? Earlier we were early into this, but should we have a relook at green? Probably this could do much better than other themes.
You are right. There are significant interest in ESG. You are also right that we were a little ahead of time in 2017. But one lesson we learned is it's easy to teach finance to a chemistry graduate, and it's tough to teach chemistry to finance guys. So practice green the way you envisage to practice, it will be a challenge. If you want to practice the way market is deciding ESG, it's like lipsticking the pig. So many times some of the green ideas we first of all made 2-3 stock picking mistakes, but rest of the names we carried also are not 3-4 year ideas. They are much longer cycle ideas, and we realized PMS is not the right vehicle to do green. Endowment, pension funds, institutional funds, that's a good vehicle. So we are unlikely to redo green, even though it's too tempting. Every 3 months, I come across at least one query from large institution or a large family office saying that if you are planning to redo, we'll be happy to consider. And when you get 3-4 queries, suddenly your adrenaline goes up. You come back to office, you talk, then that reality sets in, and you begin to say, one more mistake, whatever little brand value we have will get diluted. So that we don't want to risk. Also, there is a bandwidth issue. We sometimes don't realize it. So there are 12 analysts, 3 junior analysts, 1 CEO, 3 fund managers. When you have already capital raised from investors which you are managing, you have an obligation to meet. And therefore, relaunching one new theme, a new set of ideas, and it will consume a bit of bandwidth. So we are unlikely to consider. So either 2 things will change. Either I have to increase my bandwidth. 2, our understanding of chemistry should also improve. 3, the opportunities in green space should even become wider. Once I think it was Gandhiji who said, you find the purpose, means will follow. So I should not do the fund because means are coming, because investor interest coming. I should rather launch it when we are confident and the idea flow is good. So the reverse is not happening in Insider Shadow. The demand for products has come in, which is a good sign, which is a welcome sign. At least globally, it came 5-6 years back. India, it's coming now. But demand for products has come in, but the supply of ideas are still not of a standard that we would like to. So hopefully in the next year or two, we may make that progress. If we make that progress, confidently we can do. But limitations in bandwidth tells us unlikely we are going to.
Thank you so much, sir. This was the last question of the evening. I thank every participant having joined this call, and if they are
request him to speak. Yes, Abhishek.
please.
No, sir, I am done, sir. Thank you so much.
Tushar Bhai.
Yes, sir. Only one thing I want to ask. Recently, you have closed many US clients' accounts because of some regulators. So, any chance in near future we are going to accept their money again?
Yes, certainly. We can't ignore Indians living in US as a target customer base. What we realized is there are too many regulatory changes that have happened in the last 3-4 years, and there are certain gray areas. Should we or shouldn't we do? Are we doing the right thing or are we breaking law? These are all certain gray areas. As you might have seen, last year we applied for mutual fund license also. When you apply for certain types of licenses, the last thing you need is not being sure of whether you are in line with other regulations. So we revisited. We had councils to advise, and one of the advice we got is this is a gray area. Let's clear it. Let's go back to SEC, apply, get a license, and then restart the business. So our first priority is getting the domestic licenses approved, and then we will do the US licensing. And once we get that, then we can go ahead and confidently accept this capital. We will do that.
Okay, sir. Thank you, sir. Thank you so much for giving your time, sir.
My pleasure. It's always my pleasure. I value these relationships more because these are all some of our initial investors, and also investors who, if not for anything in 2018-19, they continued investing based on the trust on Abhishek as a person, Tushar as a person, Subhash as a person. And I remember quite a few conversations I used to have with you in 2018 and 19, focusing our attention on the businesses we own rather than on the price. So we eventually got rewarded. So it's pleasant to reconnect with investors.